t'excuse. Alors, on a fait la présentation de mes coéquipiers, vous avez fait votre présentation. Donc, la présentation va se dérouler en anglais. Puis, par la suite, vous pourrez poser des questions dans les deux langues selon avec quoi vous êtes le plus confortable. Donc, go over the agenda. We'll first go over the executive summary, and then we'll go over the current situation, and we'll go over the market efficiency problem that our client is questioning about. And we'll go over the situation that is okay, where we can highlight the market efficiency theory that we explained in the news. So with the event of the election of Donald Trump and the Volkswagen scandal. We will then go over the recommendation of the portfolio and the allocation of the portfolio and the implementation of that portfolio with the hedging strategy that we recommend.
Thank you, Antoine. So just to take you over a brief summary of what we're going to be looking at today and what our goals were going into this presentation, the first thing we wanted to take a look at was the efficient markets hypothesis as stipulated in the case. So what we found, which I will explain more in detail later, based on the Volkswagen situation and the US election situation, the market is in fact semi-strong form, efficient, which means that investors should look for a well-diversified portfolio of stocks and invest in that diversified portfolio in order to mitigate against risks. Drawing from this conclusion, our recommendation is therefore that John Reed should enter into the market with a 60% allocation in equities, a 30% allocation in bonds, and a 10% allocation in cash. Again, Antoine will take us through why the specific allocation later on. He should also use hedging strategies to limit his risk, which again we will go through in the coming slides. So just to give you a current summary of where we are contextually standing. So the question posed to us is, what is the market efficiency hypothesis, and how should Mr. Reed enter into the market based on this hypothesis? So John Reed is a young retired engineer. He has an interest in the stock market, and he has been reading up in the past couple of months on performances, on the stock market performance in general, but also on financial news. So he has a general understanding of how the financial markets works. He also has paid off his $10 million in debt, and now currently has $50 million of funds sitting in cash to invest as of today. The situation posed to us is that John Reed wants to better understand how the market works, thereby understanding the market efficiency hypothesis in order to understand how the Volkswagen scandal happened in the stock market, the fluctuations that were a result of that, as well as the fluctuations as a result of the elections night, and then following that to understand how he should therefore enter into the market and allocate his portfolio in terms of his $50 million of investments. So in this section, we're going to take a look at the efficient markets hypothesis. So I will first take a look at the hypothesis in general, and then Ala will go on to explain some of the more behavioral finance aspects of this hypothesis. So there are three key forms of the efficient markets hypothesis. The first form is the weak form. The weak form states that prices reflect all information that comes from the market data. So the idea is that there is a lot of asymmetry between investors. So what investor A may know is not the same as what investor B may know, which means that there are arbitrage opportunities because one investor might have access to more information than another. The semi-strong form states that all stock prices reflect publicly available information. So we believe that our current market is a semi-strong form. The reason for this is because prices incorporates any publicly available news. So public investors are privy to public news that is publicly disclosed by the companies, and therefore prices follow a kind of round the block where there are no arbitrage opportunities. The other form of the market hypothesis is the strong form. Now this form stipulates that the stock prices reflect all information available. So this includes public information, but it also includes private information. This means that if markets are perfectly efficient, in which which case asset management is unnecessary and everyone should just hold the market portfolio, which is obviously not the case in the market today. So with that, I'm going to pass you over to Ala, who will take a look at why prices fluctuate.
Alright, so if we're just looking at theory, we know that the stock price should reflect the present value of all the future cash flows of the company. And if this were true, then stock prices wouldn't fluctuate that much because the company's outlook doesn't change so significantly in short periods of time. But nonetheless, if you look at any stock's price chart over time, you see that it fluctuates significantly. And we found that there were really three main reasons why. The first is the availability of information. So as Joanna just mentioned, people have access to a lot of public information, especially now with devices like Bloomberg and stuff. People have emails coming to them every day showing them what's happening in the market. And this causes them to react quickly to these changes, which causes prices to fluctuate. The second is competition between investors. So all investors out there are trying to beat the market. And in doing that, they become overly aggressive in their active management and start to trade more often than they would otherwise, which also causes prices to fluctuate significantly. The last reason is the psychological shortcoming. So this was briefly mentioned in the case, but it's really based off the idea that people's behavioral actions sort of cause prices to fluctuate because they don't always behave rationally. And we'll get into that a little bit more in a second. So we believe that the combination of these three factors is why markets or prices in the market aren't constant over time, despite the theory of what the stock price should represent. So therefore, we're going to teach our client that stock prices don't necessarily represent the present value of future cash flows, but instead kind of represent the opinion that people have on the stock market currently. So we mentioned some of the behavioral biases that people have, and we said that those affect stock prices. So we thought that there were two main ones that we should share with you and our client today. The first is the prospect theory, and this one is basically based on the idea that people value their losses more heavily than they value their gains. So if an investor were to lose $10 on one day, it would hurt him more than if he were to gain $10 on that same day. And this is usually scientists have proven that it's around 2 more times as heavy when it's a loss than it is when it's a gain. And this is a problem because it causes people to sell when they're low much faster than it causes them to sell when they've already made a gain and made a profit, because they're just not as happy. And so therefore, people trade much more often because of the prospect theory and their aversion to losses than they would otherwise, which again causes prices to fluctuate, as we mentioned earlier. So the second is the endowment effect, and this is the idea that people value the stocks that they hold, or any objects in general that they hold, more heavily than they would otherwise, simply because they hold them. So if, let's say, I had a mug with me, and I've had this mug for a year now, and the exact same mug was over there, the exact same one, I wouldn't be willing to trade them, even if this mug, say, was worth the same amount, simply because I own this mug and I think that it's worth more. So let's say if I bought this mug for $10, I wouldn't be willing, and I know that it's worth $10 today, I wouldn't be willing to exchange it for the same amount because I think it's worth more. And this is obviously a problem with stocks because people always believe that their stocks are worth more, and so they tend to hold on to them for a very long time and only end up selling because of the theory mentioned earlier, loss aversion, so when they're too afraid of how much they're going to lose. So again, these theories sort of explain why people trade very often, why prices fluctuate, and so why the price isn't really the present value of future cash flows, as we mentioned earlier. So using the theories that we just mentioned, both in behavioral finance and the three market efficiency theories that Joanna just mentioned, we're going to explain to our client the issue that happened with Volkswagen last year, and then we're going to go into the elections in a second afterwards. So here we have just the price chart of Volkswagen from April 2014 till August 2016. You can see that it fluctuates significantly over time. We're not going to go through every single fluctuation because that would take forever, but just the two main key points that happened. So you can see that in April 2015, it didn't go down significantly, but you can see that there was a trend going downwards in that stock over time. And you can see that over here, there was a spike in the amount of shares that were traded. So what happened on that day? Basically, on that day in April, the Volkswagen sent out a letter only to the owners of diesel-fueled Volkswagen cars. So not all of their clients, not even all of their shareholders, just the people who owned diesel-fueled Volkswagen cars, and told them that there might be a technical issue with these cars, and they wanted to look into it further. So first of all, they only sent this information to a small group of people, And second, they lied because he said it was technical issues and it wasn't. They knew that they just lied and put a wrong program in their cars. And so once that letter was sent out, some people were skeptical about Volkswagen then, and so shares were traded. And then the stock started going down slowly because slowly this information was being produced, but sort of based on the efficiency theories we just mentioned. Efficiency theories we just mentioned, this information wasn't fully public because there was a lot of information asymmetry, right? So some people knew and some people didn't. And that's why some people traded and the stock just continued to go down. However, by August, when the US authorities said that they're going to start looking into Volkswagen and declared that they had made a mistake and it was illegal, you can see that a lot of shares were traded because that's when the strong form of the market was really validated. Everyone knew what was happening, and the result of that was that the stock price went down significantly on that day. So the second situation that we wanted to explain to our client was what happened with the US elections this past year and how that related to the stock market. So we believe this situation can be more explained with some of the behavioral finance finance theories that we just mentioned right now. So you can see that there were three main dips over the past year. This is from January 2016 up until December 2016. So the first one was in early February, and this was after a Trump rally in Baton Rouge. And so basically this was one of his first main events after declaring that he was going to run for president. And the place was completely full. It had never been as full as it was that day previously in history. And a lot of people saw that a huge portion of the US population was in support of Trump, and that worried investors because they were very uncertain about what he would do as president. And this uncertainty sort of caused people to trade a lot of shares, and the Dow Jones fell. So what does this uncertainty relate to? It's more related to the prospect theory and loss aversion. People were very worried about the amount that they would lose, and because they weighed their losses more heavily than the potential gains that would happen, say, if Clinton won, or potential gains that if they bought at this low price and then sold later, they wouldn't want to take that risk. So instead, a lot of people sold, and the price of the Dow Jones tanked. Then a few months later, in the summer, the CNBC polls stated that the race was a lot tighter than they thought it would be. So they saw that the swing states were much swingier than they thought earlier. And it was there were high 40% for both Clinton and Trump. When people saw that, again, the stock prices tanked because they were still at that point very uncertain about what a Trump presidency means for the stock market. However, a few days later, the stock price went up because people sort of forgot about it or tried to ignore what was happening in the market because, again, they just simply didn't know what he would do. And then finally, in early November, when polls actually opened and people started voting, you can see that the price of the Dow Jones fell early November. This was around November 2nd, November 3rd. For the same reasons that it was going down before, so ongoing uncertainty. There was also a potential rate hike by the Federal Reserve, but they just mentioned it. They didn't say that they would for sure do the rate hike. But then the Dow Jones started increasing, which was interesting. So it started increasing up until November 8th, which was the day of the elections. And then when Trump won, I'm sure we all remember this, but the stock market did way better than people thought it would. And that's because the market sort of early November, when it started to look like he could have a chance to win, they sort of took in that reality and started to actually think about what a Trump presidency means. And so a lot of the stocks that did well, including the Dow Jones, were stocks that would have done poorly had Clinton won. So things like private prisons or a lot of the infrastructure companies would have done well if Trump won. And because of that, because investors sort of grasped that reality, the Dow Jones ended up doing much better. And then again, people expected it to tank the day after the elections when people woke up and realized that Donald Trump won. However, you can see that, I can't really point at it, but it sort of went up and then stayed flat for the next few days. And this was following his speech, his acceptance speech, which was a lot calmer, had a much calmer tone than people expected. He didn't mention the wall, he didn't mention Mexico, he didn't mention anything that sort of upset people. And because they saw that he was very calm, they trusted him much more as president, and so the stock prices didn't end up tanking after his presidency and just stayed flat. So now that hopefully our client and you understand a little bit more about the different types of market efficiencies, how they relate to the situations such as the Volkswagen scandal and the Dow Jones movements during the elections over the past year, we're going to go ahead with, Antoine's going to go ahead and explain how he can use these theories to help better invest his money.
Okay, so the clients wants to enter the market with the 50 million of cash that he needs to invest. So there are three considerations that we are considering. First is the diversification. Of course, we want to minimize the idiosyncratic risk by having as much stock as possible and only having systematic risk. So for that purpose, we believe that investing in ETF will provide diversification while maintaining the transaction cost low, because it will comprise a lot more stocks with one transaction. And then of course there's the timing, because you can't really invest in the market directly. The 50 million will make the market fluctuate, so he needs to time his investment. And we will talk about the hedging strategy. Of course, the clients want an hedging strategy to minimize this risk pertaining to the market. So this is the allocation that we recommend. So we recommend having 60% allocated to equity, 30% allocated to bonds, and 10% in cash. So the allocation in bonds might seem quite high right now, but what you need to keep in mind is that our client has no job right now, so his human capital is really low, almost none. So the income that he will be able to generate with his job is none. So he needs some stable cash flows that needs to enter in his portfolio. He needs some. He needs the stable cash flow that bonds provide. So that this is what we think that 30% allocated to bonds is a good allocation, and it goes into his risk profile that Joanna talked about before. So in terms of the actual allocation of the equity portfolio, the asset mix would be 70% allocated to SPY, which is, it replicates the market portfolio, basically, the S&P 500. So, you know, the market portfolio, we believe, has the highest Sharpe ratio. So investing in the market portfolio will provide diversification and reduce the idiosyncratic risk, like I mentioned before. And then 30% allocated to an international index. Of course, the allocation will maximize the Sharpe ratio of the portfolio. In terms of hedging, we recommend that the client uses a collar strategy. So we recommend that he hedges 80% of his exposure in equity to minimize the downside potential. Of course, we don't want to hedge 100% because it minimizes the upside potential as well. So, okay, and we want to keep the collar at 10% upward bands and a 10% downward. So to do the collar strategy, you need to long a put that is out of the money, so at a strike price that is lower than the actual current price at which the security is trading. And then you need to short a call that is out of the money as well with a higher strike price. So usually following the put call parity, the price should cancel out, and so it will provide the diversification needed for our client. Of course, this strategy will be on a rolling basis and will be replicated along the years to hedge the risk to the client. So,
just to do a quick summary of what we presented to you today. So we began by taking a look at the market efficiency theory, in which we stipulated that there are 3 key ways in which the market can be efficient. We believe, based on Al's analysis of the Volkswagen as well as the US elections situations, that the market is effectively functioning at a semi-efficient, semi-strong state, which means that it is worthwhile to manage your assets, which is what we recommend. But however, that there are no arbitrage opportunities. So for this reason, we recommend that you should, in fact, invest in a portfolio that is well diversified in order to mitigate against risk, but at the same time based on the client's risk profile, which, as we mentioned, the client is very young. He has a lot of time on his hands in order to manage stocks, and we believe that this 60-30-10 allocation is an optimal way for him to be diversified diversified but also manage against risks. So that concludes more or less our presentation. Thank you so much for coming and for listening to us, and we open the floor now to any questions that you may have.
I guess I'll start. You mentioned that the recommendation to invest was to go with ETFs.
Yeah.
It's a way of investing in a basket of individual stocks or bonds. Any particular reason why you would not go in an individual built portfolio customized for this client, especially if he's investing $50 million?
Yes, so our thinking behind this is that the client is not working in a specific industry. He doesn't have like risk to which he is exposed to. So particularly, we would build this kind of portfolio to mitigate the risk that he is exposed to. But right now, the only risk that he is exposed to is mostly market risk. So we believe that investing in ETF will provide the diversification needed with lower costs. And so for that reason, I think the ETF is the best.
To add on to Antoine's point, I think we had discussed, of course, him potentially investing in individual stocks. However, given his knowledge of the market, and given that he doesn't quite understand market efficiency just yet, he is relatively young, we suggest that he begin with investing in ETFs because it'll achieve that kind of maximum diversification and exposure in the short term, especially because if you're investing in the SPY, investing right away 50 million isn't actually going to move the market, whereas if you were to invest a significant amount in a particular stock, he would have to know how to hedge it properly, he would have to know how to go about doing that on a timely basis. So we believe that going forward, it's definitely an opportunity for him to look at. But we believe that right now, since he has 50 million to invest today, ETFs are a good way to go.
Well, maybe just a quick question for curiosity. Why specifically 70-30 into MSCI and S&P? Why specifically exactly these two?
Sure, absolutely. So we decided to take a look, and maybe Alpha can help me out with this, but we decided to take a look at the U.S. market and the international market. So the MSCI that we're looking at is actually the international kind of ETF index, right?
Yeah.
The reason why we decided on 30-70 is because our client is not currently working in the U.S. because he doesn't work, right? So he has a lot of time on his hands to figure out a portfolio. We believe that he should invest 70% in the S&P 500 because the majority of large cap blue chip stocks are in fact incorporated in the United States, and we believe that this is a good representation of the market. However, we do absolutely admit that there are a lot of companies that aren't covered in the S&P 500, which you may want to look into. So again, we're looking at blue chip stocks and stocks that have a high market cap, right? So that's why we decided to allocate a certain amount in the MSCI. Obviously, going forward, if he chooses to hire us as his investment advisors, we would look into what combination of these two ETFs will maximize his portfolio Sharpe ratio in order to find the optimal holding.
Cool.
Thank you.
Good.